today's class, the breakout session is reading the 1040 with confidence and how to turn the tax data into smarter client planning. If you went to the last session for the, the shout out of the, great ideas, both Terry and Heidi were talking about how kind of the connection between AFC, CFP, and really everybody in the room. And that was my ultimate goal with this class, is I'm on the tax side of the house. This is me. And so really, even though I'm an accredited financial counselor and I'm an enrolled agent, my focus is on tax, but still, like, I use everybody here in the room as well. Like, we're peers, and you build me up, I guess is the best way to say. So I'm a founder of Spire Financial Consulting, enrolled agent, tax accountant, ASC, and I specialize with military, veterans, and expats, international organizations like the United Nations, and of course, our whole overseas international side of the house, ACONUS, for active duty members or, government employees that are serving on missions overseas. And then I'm also a member of Military Tax Expert Alliance. So in this house, as far as like communication, if you guys need help, go to Military Expert Tax Alliance, and we will, we should be able to service you, or at least get you in the right direction. So so the class is for to ask for the tax return to get better answers. And in the polls, we have like quite the range. We have people who've like basically never looked at a tax return before in their life. And then we have people who are, looking and reviewing at over 100 returns per year. So again, this class is going to kind of be the big bubble, the big brainstorming session, so that we can try to all get a little bit of something out of this. So let's jump into it. It is about reading the 1040. It is about spotting changes for the taxpayer between years. It is about using the tax return to create conversations and ask questions with your clients. And then it's also about knowing when to refer out. What it's not, we're not doing tax prep here. This is not tax prep training. It's not. It's not legal or tax advice. Don't take anything that I say here and then try to apply it to a situation and say, well, Christy said. No, she didn't. It's not a review of every single line on the forms. You will see this is broken up, like the only 2 pages is broken up into 5 or 6 slides. So we're not going to go line by line by line. And it's, again, not a replacement for professional help. I wish that little bar was down there, but that is the barcode to get to militarytaxexperts.com. And this slide didn't really come out the way I wanted it to, but this is the 1040. So again, the main thing is ask the client for the return, like wherever you are with that client. It might be on the onboarding session, it might be a quarterly. If you don't have the return, ask for it. And then you can start, slowly learning as you read more and more of these 1040s and how you can fit them into your practice. So normally what I find is, especially if someone goes to like H&R Block, each software is a little bit different, but it will spit out about 5 or 10 pages before you even get to the return. So the number one thing we're looking for here is this 1040. And these are the main 2 pages, page 1, page 2. These are going to change every year. They look different. Back in like 2012, they were like, oh, we're going to put it on the size of a postcard. No, they didn't do that. They added like 6 more schedules and just additional paper. So right now, you're always going to start with the 1040, and you're really going to kind of narrow in on these first 2 pages, and then you expand from there. I kind of like to think of the 1040 like do you guys ever remember those like choose your own adventure books where you would like go down in the bottom? It's basically like somebody at the library had already filled it out. And so now we're just going to have to go back through it and make sure we make the story right. So the 1040, these 2 pages, is covering all these things. And I'm not sure if that green is good, but identity, income, adjustments, that could be plus or minuses, Deductions, so itemized deductions, standard deductions, tax, non-refundable credits, more tax, payments, what you put into the piggy bank, refundable credits, what they're going to give you, and the results. Do you owe or do you get a refund? So let's go each section one by one. Start with identity. If you do nothing but just pick up the 1040 and read this first part of it, you're already like farther ahead than other people who don't ever look at the 1040. It's very hard to see, but here in this top part, it's saying combat zone. If you see that checkbox on it, guess what? They've been in a combat zone in the previous year. So you can, it's the return is always going to give you more information if you just kind of read through it and start to put together that story. Here we have Jerry Hayes. Oh, I forgot that they're married, filing jointly. Liberty Hayes, and they're living over here in Virginia. And one thing I thought about right away is that, like, right now we're in Savannah. So if I was practicing in Savannah and thought the people lived in Savannah, this would throw me off. And I'd be like, what's going on here? What are you living in Virginia? Or are you living in Georgia? And there's opportunity right there for you to go onto the IRS website. You can self-service, the client can self-service, and they can update their address if their address is wrong. So, I mean, it's just something as simple as kind of keeping everybody in line. The IRS wants this address if they're going to send them a nasty gram. So, or good information, like a refund check or something like that. In the next part, we have the filing status. Again, this is going to kind of show you what's happening in that household, depending on if you have like a divorce situation or if you have a new single person that's entering service. We also have our qualifying survivor widows. This is only going to last for a couple of years, but still, you see that box checked and you know something happened to their spouse. And then we have a little bit of the ACONUS situation over here with our non-resident aliens. So really, again, it's just kind of giving you a picture of like who's in the household, what's going on with these people. And then you have first the digital assets. If you've got somebody who's playing with crypto or, I always forget what those things are. We actually have like a horse or something that you can race, but it's basically like a pixel that you can buy. So if you're trading those, then you're going to see this box yes, and you're going to know that they had, they've sold some Bitcoin or they've done whatever. And then we have the children here, the dependents. The dependents might not all be children. It could be a parent that somebody's taking care of. It could be a child who's away at college. But they still might wind up here. So it's very important to kind of see who's in that household. And guess what? It's not uncommon for many of our bigger families that there's a whole extra page just for the additional dependents. Once we get past 4 dependents, we got to get a new page. So it's so small, guys, I'm sorry, but this one says, check if they lived with you for more than 6 months during the year or more than half of the year. And it's gonna, say here, it's like, yes, they did live with me for more than 6 months. Yes, they did live with me inside the United States. So we know where they're at, what they're doing. And it's also very hard to see, but it says, are they a full-time student? Are they disabled? Are they a child? Do they qualify for the child tax credit? And then or if not, are they over the age of 17, and do they qualify for the credit for other dependents? So again, just this one page, if you just ask about this, you can start a conversation very quickly with your clients, just kind of understand what's happening in the house. The next part of the 1040, those first 2 pages, is the income. And this is the one where there were a lot of people in the polls that were like, I have problems kind of following the income throughout all of the additional returns. So I'm going to try to give you guys kind of like some cheat sheets that I use every day, every client, even repeat clients. Find the number, scan, just scan. Find the number, move over, what is it? This one says it's total amount from Form W-2. If someone doesn't know what a W-2 is in here, I do have a sample, but you know, it's your wage income. So it's going to show what did your employer pay you and what was withheld for your taxes. It also shows great things like what did you put into your 401k, you know, what your health benefits and so on and so forth. So the new 1040 for 2025, it actually has a breakdown. You'll see like this is tip income that wasn't reported. Here is taxable dependent care benefits. So, you know, maybe if your FSA comes through and then you have taxable benefits, that might show up over here. Other earned income. I mean, it's really vast. It could go that it's earned income, I should say, but really all the things kind of fall into this first chunk of earned income of one. Then we go down to 2A. You kind of see these like bits in the middle. These are non-taxable bits. Things are not getting taxed. Like we're going to report the amount, but it's not going to come through. And then over here we see 100. What do we got? Can anybody see this? So it's dividends. This is what we got is dividends here. So this part of the dividends is taxable. These ones that are qualified, they get a better treatment. And then as for example, you know, say you did have more numbers here, you just pull over, oh, this is pensions and annuities, I guess, you know, and then you just keep kind of going slowly through. The kind of interesting part here is, I wish these weren't so small, but we'll go over them again. What happens is once we add up all the income, we get total income here, and then we start making adjustments, and that's on a form called Schedule 1. And Schedule 1 does two things. The first part of it is going to be more income, and the second part is going to be adjustments. So it might be something like, I paid student loan interest. I think we find that in this one. Yeah, that's the 85, or, well, there's a couple things there because it's also self-employment tax, but it's going to reduce the taxable income. So we have total income is 197,668. But then once we reduce it by the adjustments, we're 193,740. That's the AGI. And I had a whole bit on this, but you know, I think it's really important, and I'm getting too hot. I think it's really important that we understand that, you know, we're not the only ones that are looking at this. This is another reason why I think everybody should just kind of at least wrap their heads around it. I mean, this is the first thing a lender is going to ask for. This is the first thing that when somebody's going up for their security clearance, they better have this form filled out. Whether they owe or not is really not really the issue. That's where we can come and step in and help. But, you know, we've at least got to know that these things are being taken care of. So, okay. So that's just the income, guys. We're just coming up with income in the AGI. Then we go over to taxes. So the total adjusted gross income comes over the 193. They get a standard deduction, or excuse me, we go, yeah, taxes and credits. They get a standard deduction or itemized. There's another slide on that. That's on Schedule A, extra form. And it's telling you here, again, you see a number here, standard or itemized from Schedule A. You'd have to see over here, it's standard deduction is for married filing jointly is 31,500. 31,500. Okay, they are taking the standard deduction. They are not itemizing. It's like right here in the little column. Just got to kind of break out the magnifying glass. We then get our section for, well, this one has a qualified business income deduction because, again, the hidden income here is Schedule C. And then we come up with the total taxable income after we get some more reductions. We reduce it by the standard deduction and reducing it by this qualified business income deduction. So taxable income shows up at 152. Tax is 23,267. And then we start talking about non-refundable credits. And non-refundable credits are going to come on a new schedule, Schedule 2. So there's a whole, again, another long line, lots of little lines like this that we can talk about for the Schedule 2. They're not getting anything for Schedule 2, but what they are getting is the child tax credit. of $4,400. That's for 2 children in 2025 under the age of 17. And that goes directly towards paying the tax, right towards the tax. Then we are left with this $18,867, and then we're going to talk about the other taxes. So the other taxes in this situation is the self-employment tax. You guys can't see it yet, but that's what it's there. You kind of just have to follow the lines. And for the self-employment tax, that's an extra tax. It's gonna get added in. So the total tax for this family this year is this $26,623. One thing I'll say about these schedules, and I do have a little kind of cheat sheet in a little later about these, like kind of like the big forms that we're looking at, is in that Schedule 2 in these other taxes. When you see something there, you need to hunt down why there's a number there, because it could be a penalty related to early distribution from a retirement account, which again, that in my opinion is poor planning. It's just poor planning. And I see it every year. I have somebody right now where it's like they dumped out their TSP because they've gone through multiple moves from overseas and back, and now they have a $7,000, early withdrawal penalty plus the income tax, which is another, they're over $9,000 that they owe to the IRS. Makes no sense. And they're saying that they're, why didn't you call me? Why didn't you call me? So, and that's kind of, again, that's what the whole point of this is. Like, I hope we can all in this room help people so they don't get in. By the time we get them as tax professionals, it's too late. It's already done. The deal is done. So taxable income tax, non-refundable, more tax, total tax. Then we have payments and refunds. So kind of like our refundable credits. So what kind of goes into the pot? So first we have the withholdings from the W-2. Again, we want to work on those withholdings if you have earned income throughout the year. And if you are working with somebody who is a business owner and they are reporting on the Schedule C like this family, then you maybe should consider estimated payments. If it's not going to come from the active duty service member out of their wages, then it's got to come from somewhere, or there's going to be a tax due. They did make estimated payments on this one. They made estimated payments of $4,400, and so they have total payments in the piggy for the IRS of $24,373. But when we go here, we realize the difference between the two, what the tax due was, what payments they've put into the piggy. They still owe $2,250. And this is another one that's kind of like a gripe for me, because it's not showing up in this for this family this time because because they haven't had a tax before. But in the future years, like if this behavior keeps repeating themselves when they have not put enough money aside for the IRS throughout the year, they will get a pretty estimated tax penalty right here in box 38. So it's going to push up that $2,250 even more, just because they simply didn't set enough money aside throughout the year. So that is where, once again, you guys during the year working with clients can make sure that they avoid this kind of situation. You see that they owe, you see that they don't have even if they do have a penalty, you know that they are not withholding enough. They need to set aside more. And then down here, another one, again, we're just kind of creating conversation. If the preparer, properly filled out the information, I can tell right now that this person is active duty, and I can tell that the spouse is in digital marketing. I mean, what we do, who we are, I mean, that is important in my conversations. So it's there. It's there on the, again, you can just ask and look. Here's the trail when, and again, the poll was like, how do I follow this? So it's kind of going back. I think my arrows should go the other way. But the 1040 line 8, like when we saw that, it was leading and telling us, like, go to Schedule 1. That's the next form. That's the number up in the corner we're looking for, not the 1040, the Schedule 1. Then it's, once you go on Schedule 1, you'll see, okay, this line, what is it? Oh, it's Schedule C, it's business income. So then you go over to that form, Schedule C, great. In our other, so here's, this is what they look like. as you flip through your forms, this return was 25 pages, I believe. And again, we're stripping it down to like 5 pages for you guys. So, just to make it so we can fit it in. But Schedule 1 is additional 2 parts, additional income, adjustments to income. And then the Schedule C is our business income. And we're not going to cover that. Emily went over Schedule E yesterday, and just like errors on the Schedule E took 30 minutes. So we're not going to get into the weeds with these guys. Then 1040, line 23, that's going to point to Schedule 2. Again, another very important schedule. And the reason why it's shown up in this return is because of the self-employment tax. So Schedule 2 is additional taxes. Remember that additional add-on. And then that feeds to the Schedule SE, which is self-employment tax. So the connecting schedules that we've kind of it's hard because the 1040 is like the table of contents essentially if you're thinking about a book. So you find those numbers, you scan for numbers, you read what it is, and then you follow the form into the following pages. And then you find the number again, move over. Does it have enough? Does it keep going or not? Right now, we've talked about Schedule 1. We talked about Schedule 2, additional income, adjustments to income, additional taxes, and technically non-refundable credits. And then there's the new one for 2025, Schedule 1A. And we can't really unfortunately, once again, not enough time to deep dive, but there is, depending on if your vehicle is qualifying, there is, and you have a note out on it, there is an car loan interest deduction, which again is just going to automatically reduce our income. And there's the, no tax on tips. So if you have your tips reported or you can, justify those are coming off. And there's what we have overtime. It's overtime premium, I should say. That's been really fun this year for tax preparers. So it's not the overtime, not your base page, but it's the bump. Whatever the time and a half, it's the half. And then there's the senior deduction. And throughout all of these, which is really nice, it's $6,000 as I recall, per, depending on your age, if you qualify as a senior citizen. So that has been really helpful for some of my retirees this year, going from O to refund. And then Schedule 3 did not show up in this return, but that is going to be in that payment section that we went over, where they had the withholding and they had the estimated tax payments that they made throughout the year. This is going to be additional refundable credits. So if you didn't use all the child tax credit to pay your tax, that $4,400, let's say they only had to use $4,000 because of the tax was paid. Well, the $400 they'd get back. They'd get that back. So. And then it's also that Schedule 3 is other things that are kind of interesting. In our military community, a lot of repayments happen with DFAST. DFAST finance is just so fun. So you're going to find, I would say strength. Usually it's going to say, again, you follow the number and you'll see what it is. But there's some interesting things there in that Schedule C for our military. Earned income credit, that's another one that's going to show up in the Schedule 3. And again, that's all refundable money that the taxpayer can get back in a refund. Here are the other forms. Again, when you're reading through, you see the number, you go over, where's it going to? Schedule A is our itemized deductions. That's if you have enough. I mean, we saw for married filing jointly, it was $31,500. You really have to have a lot of mortgage interest, and you have to be paying a lot of taxes in order to beat the standard for most people, especially if you're active duty and you are just renting and you're on an overseas assignment. You're probably not going to be able to itemize. I did not itemize with my husband until we got out of service and bought a house. And we live in New Hampshire, so we pay high property taxes. What was nice about the changes in the OBB bill is that they eliminated this. Well, they didn't eliminate. They upped the SALT, which is state and local taxes. That is one of the big deductions that you can use. You know, if you live in an income tax state, you would be able to set aside whatever kind of withholding you set for them, your property taxes, any personal property taxes may be on your tags for your vehicle. However, it was capped at $10,000 last year. And now they've upped it. So married filing jointly is $40,000, which is great. So a lot of people who couldn't itemize last year can itemize this year and will be able to in the future. One thing that's big that I didn't have on here, but I think it's important for any of your clients who are giving, you know, that are big charitable donators, there's a 1% floor in 2026 and going forward. This is really going to affect our planning. Yeah, it's really, I have a few clients where I'm just very, very concerned about this because they're so generous and it's going to hurt them. It's going to hurt them when they have to spend 1% before $1 counts towards the itemized deduction. And what I would say about that too, for planning purposes, is really kind of consider if you have somebody like that who is a big, you know, giver, that you kind of lump together those donations in one given year so they can get the best bang for their buck at reducing the income. So let's say, you know, if somebody does like 10,000, 10,000, 10,000, maybe suggest that, why don't you just give like 20? And then, you know, then it might be a little bit, might make more sense for those guys. Schedule B is our interest and dividends. You saw the dividends on that first page as income. Somebody else was talking about it too in the last session, where you know, your high income earners, I see it all the time. I see it like, oh, I make $400,000. Excuse me, sir, do you have any interest? No, I don't have any interest. You have any dividends? No, I don't have any dividends. What? Where is your money? How do you not have $5 from your checking account? Like, I don't understand it. But it does happen. I do think I have some unbanked people, but anyways. The Schedule B is really good. If, you know, even as a new service member, most people are going to have some, again, bank interest or something if they have their emergency savings set up. So then Schedule C, big one, business. Again, we're not going to get into the weeds, but essentially it's, you know, how much money did they make, what qualifying expenses do they have, and then what the net is so that we can figure out that self-employment tax. Schedule D is our capital gains. You're going to find it two ways. Sometimes it's coming straight over from the dividends, it's just a return of capital, and then or a capital gains distribution, excuse me. And then other times it's going to be an actual sale of stocks or ETFs and so on. So. And then Schedule E, which Emily covered yesterday, of errors and things that we don't want to do on those, is going to be your rental. It's also going to be royalties. Like, I have a lot of people who are composers, and so they're, you know, whatever songs or things that they've written, they're getting royalties off of those. That's going to be on there. It's also going to be like partnership income, S-corp income. That's going to kind of flow through over to this Schedule E. So once again, it's like, find the number on the Schedule E, roll it over, what does it say, and then, you know, keep following it kind of through. That's the easiest way to connect those the income throughout the 25 pages of return. Some of my favorite forms, and I actually have a bigger list than this because in the expat space there's a lot more forms that I run across. But for our military families, the 3903, that's going to be for our moving expenses. With MTEA, we have talked about it many times, but you know, every branch of service is doing these kind of a little bit different. Did we say that? I think Jerry said that the Air Force is probably the nicest looking one, but was it? Coast Guard, sorry, Coast Guard was the nicest for these moving expenses, but really, like, in the you know, for our purposes, if you're not preparing taxes, our job is to get accurate, you know, records to report on the form. From a reading standpoint, you're just looking at, you see a 3903, you know they're active duty, and you know that they've PCS or they've moved over 50 miles. So that is a big change. Again, is that address right? You know, what else is happening? What other kind of conversations could that spark with, if they have, depending on if they have children, or again, if they do have dependents as parents, like, you see the form, you see moving properly, and get it over to the IRS before penalties are assessed. It's also important too, because if they do decide later on that, hey, I want to take out of this traditional and start moving over to a Roth IRA, well, again, they haven't paid tax on that $6,000, whether it's on the 8606 or not. So if we fail to get that form in the pile, and it could be because of the tax preparer, or it could have, it could be because of the client. There's all kinds of reasons why the information doesn't flow through properly. But if you have second eyes on it, you see it, you can address it, and again, make the client's life better. Because it's tracking after-tax money. Again, they've paid tax on that money when they weren't. Well, yeah, they were supposed to. 5329. This is another one, like my TSP guy who took out all of his money. Guess what? He got a big 10% penalty for taking out before he was 59 and a half. So the $7,000 that $79,000 of his penalty was right there on that 5329. There are exceptions depending on what it is. Again, if you have somebody who's in that kind of dire situation, who's considering taking out their TSP or their 401k before they're of the right age that they're going to face that penalty, double check with a tax professional to see if there's any exceptions. There's hardships one now. Secure 2.0 has changed, so there's a little bit more movement. And then some things work for the IRA and some things work for the 401k. So you need to talk to somebody who knows what's what and see if there's anything that you can pull out without being subject to that 10% penalty. And again, you see 5329, something's going on. And it reports other things, other penalties too, but that's the big one that I see, and it's right on the front. And then 2441, that is another big one for our families, growing families, especially if you're active duty, and that is your child and dependent care expenses. If they're participating in, because now there's the FSA block, right? For active duty. So if they're participating in that FSA, I would just say that, you kind of have to, you might want to get with a tax professional just to see if you're actually maximizing that. People with higher income, it's going to be better to get into the FSA, take the non-taxable benefit right on the W-2 right ahead of time. And other people, because this is going to reduce, like if they go through the FSA, they're not going to be able to take the full amount on the 2441 for the child care expenses. Like, let's say they spent $5,000 in child care, and then they, through their FSA, through payroll, they spent $4,000 was paid directly to the school. Well, they're not going to get to take anything for this credit. So in some cases, it makes perfect sense to do that because they've already lowered the tax and reduced, they've reduced the taxable income. In other cases, the credit's going to be better. Right now, it's still capped at 20%, but back during COVID days, in the later part, it was 50%. So there's going to be a big difference if I reduce the income by $4,000 and they're in the 10% tax bracket. Oh, that's like, ooh, what savings? Or if I can get them back, it is a non-refundable credit, goes right towards the tax, but if I could get them back more with actually claiming the credit. So again, you see they're participating in, kind of work the numbers and see what makes most sense. Normally, higher income, going to be better to get your FSA money out and reduce those taxes because your tax bracket is too high, your effective tax rate is too high. But I would say for lower income, the FSA can really kind of hurt people. Somewhere in there, so that really, those are kind of my favorite forms there. Again, I could go on a whole nother tangent about expat returns, like foreign earned income exclusion and foreign tax credits and you name it. But things that you can use, probably stuff that you're going to see, is a prior year comparison. Somewhere in there. 10? Okay. Somewhere in there. And I'm pretty close. I think the big point is right here, like, it was bad because I do have the W-2 up here over on another slide, but what happened in this situation is this person received their bonus. I think it was $79,000, well, $74,000 bonus. This is one active duty member, and in 2025, again, they received this bonus, and so income significantly increased by $74,000. Their dividends didn't really go up. In their gains, there was a little bit of a loss. One thing I didn't mention about those investment, I see dividends, 23, 40,000. I see crazy amount of money coming through from the investment side of the house. Make sure that the client understands what's going on there. Do they understand that they're making $30,000 in dividends? And do they understand that they're making $60,000 in capital gains because you moved around some things to balance their portfolio? You'd be surprised they have no idea. So kind of the comparison is, if you can find this form, sometimes it's 3 years. And if you can't find the form, guess what? Have another conversation with the client. Can you give me your prior year? Can I see your 2024? There's nothing wrong with just asking for more information. And whether you use it or not is, at least you have an opportunity to use it, I guess is the point, and see what kind of has happened in the family. This is going to go over like all of the same kind of lines that we've talked about before. There's the business income. You can see it's shot up by 25,000. So kind of this makes sense that they ended up owing, right? Like, look how much more money they've made. And again, additional taxes, everything goes up. So this is the second part, and you can't see it down here, but this is the effective rate. So they're 13.5. This is what they actually feel, if you will. They could be in the 24% tax bracket. That's not really what, it's a graduated system. But 13.5 is what they paid, based on total income. And then it shot up to 17.51. I find that, that 4%, that can really affect a family if they're, if they're watching their budget and they're trying to do good, this swing in tax can really hurt somebody. So again, just by going and looking at it, you have a better opportunity to service your client. And so these are the guys that I spent a lot of time on, and then they didn't find anywhere in the slide. And so I was just thinking, if you guys could, based on that return that we went over, where is it? Is it this guy? Is it this person? Is it these guys? How about middle? Okay, yes, middle. So we've got 2 children under the age of 17, and this guy's supposed to be in college. And of course, we're not retired or anything like that yet. What's that? Yeah, he's taller than everybody else. Yeah. Well, and I was going to make a joke about the guy's beard too. Like, he's clearly on deployment, right? So all throughout his career. So this is the big one again. Go to IRS.gov. They have a whole section for taxpayer tools. These are things that you can use with your client. You can, sit behind them and have them push the buttons, or you can say, hey, go follow this thing. But the tax withholding estimator is huge. It's huge. It's going to be the thing that says, do you owe or do you get a refund? So if they've owed in the past, if you see those estimated tax penalties, get them to fill this out. Help them. The IRS will tell them what the W-4 should say on my pay, like how to make the corrections, and so you get enough, or how much extra money should be set aside. IRS online account too, another one. You ask for the return, let's review your withholding, let's set you up an IRS account. If they don't have one, it's kind of, to me at this point, it's crazy. You need an ID.me account, and you get in there, you can handle your payments, you can see your transcripts, you can, it's just a really great resource. And the IRS tends to be improving it time after time. And that's it. So, it's a starting point. It's not the whole story. There is things that are missing, but I would highly encourage everyone in the room to just pick it up and read it and take it section by section, look for numbers, follow it over, keep going down. All of the forms are highlighted at the top in the bar, and then just slowly kind of see where things are going. Any questions? I think I have 5 minutes, maybe.
Yeah, 5 minutes.
Any questions? Any questions? No? Was that helpful? Okay. Oh, go ahead.
Oh, wait, hold on. They got to.
Oh, yeah, sorry, Sarah.
Record it. Sure.
Thanks. Could you talk a little bit about estimated quarterlies and safe harbor, and making sure that estimated quarterlies are equal and the penalties if not, please?
Yes, so there's a couple different, well, it depends, number one, on how much money you're making. So the safe harbor side of the house is normally it's either 100% of the tax that you paid in the year before. So for example, if we like roll back, so total tax $26,623. In theory, come 2026, he needs to have at minimum this. And I do believe because he's at 190, well, 152 is probably fine. But there is a threshold that once they make over a certain amount, they should be withholding 110% to make that safe harbor. So, and that basically is saying if you withhold 110% of your tax from the prior year, we're not going to give you any estimated penalties. But again, that has to come through payroll or W-4, or you have to physically make voucher, you have to send some money to the IRS, set up the IRS online account and, make a direct payment to them. As far like, in theory, you're supposed to be making the first quarterly payment is April 15th for the following year. And then we go into June, and then we go to September, and then we go to January. So it would be spread over four equal payments. There is kind of a, you find somebody in January, the beginning of January, you're like, oh, wait, there's going to be a problem here. If you can work with a tax professional to find out what that tax is going to be for the given year that we're going into for that tax season to report, they can make a payment by January 31st. So like the tax is paid, like they're getting a refund, or they're at zero, and the IRS is really they're not really gonna assess anything because they have their money. They have their money in the pot like by that January 31st. But if you still end up owing like over $1,000, I think it's over $1,000, then again, that estimated tax penalty is gonna kick in again. My goal is always to get closest to zero. I don't want people getting a windfall. That's another one I didn't even mention. You see somebody, I see it all the time. You get $23,000, you have to wait for the IRS to pony up that money that you've been giving them, interest free. That's bananas. Somebody could be using that money throughout the year rather than giving it to Uncle Sam. So, big refunds, we want to get close to zero. If we owe them a little bit, no sweat. If they give us a little bit, no sweat. Anything on the edges, there's problems. Okay, did that answer your question? Okay.
Make next year's calculation, like maybe it would be to their benefit to do 100% of this year because next year they probably won't owe as much.
That's it. So again, if they don't end up owing, like if the tax goes down to $15,000, then there's no way that a penalty is going to be assessed because they'll likely have enough money in the pot throughout the year. But then I didn't get it in the slide, but I just want to show you guys this. Let's see how I escape for the W-2. I need to give you guys an idea. I meant to put it in there. Like this is what this look at the W-2. Check it out. Oh yeah, let me just try. Yeah. Okay, so here you can see where the bonus is coming in. 71,000 is actually FICA, like subject to Social Security and Medicare, and then the rest of it is all bonus because it's not subject to Social Security and it's not subject to FICA, that bonus income. And they've withheld the 19,000, but it's not enough. And then the big one is down here in this box 12, code 12. You don't see anything there. There's no Roth. Oh, I gotta go. There's no Roth estimates, but there's no Roth contributions to the TSP, and there's no traditional contributions to the TSP. So, but thank you guys. Thank you, everyone.